Welcome back to the Deep Dive. This is a special one today, a dedicated Hive 5 Dispatch Deep Dive, produced for you by Borghi Consulting and the Crypto Education vertical.
And the timing is pretty incredible.
Incredible's one word for it. I was thinking, well, schizophrenic might be a better one for the last 24 hours.
That's about right. It feels like you're watching two different movies on the same screen.
Exactly. You look at the price chart, and it's a horror movie. Total stress.
But then you look at the actual news, the infrastructure stuff, and it's a documentary about the future.
That is the exact disconnect I want to get into today. Because on one hand, yeah, the charts look bad. We've got Bitcoin printing this macro stress candle, as the analysts call it. Mainstream media is screaming shakeout.
It feels awful emotionally. But that's the danger of only looking at price. While the price is loud, let's call it the plumbing of the financial system, it's quietly getting this huge upgrade.
So that's our mission for this deep dive. Yeah. We have 5 specific headlines, from Stripe agents all the way to European banks, and we're going to look at them through that Hive first lens.
Yeah, we want to see past the red candles and understand what's actually being built.
Okay.
And we need to set the tone here. This is about being calm, precise, and decision-led. No hype, no panic, and definitely no price calls.
It's about separating risk from noise.
That's it.
Yeah.
Because right now, to the untrained eye, they look exactly the same.
Okay, so let's start with this executive macro synthesis. Bitcoin is down, people are nervous, but you're saying the Hive lens changes that picture.
It does, completely. The lens teaches us that while prices drop, the distribution rails are, switching on. And to really get that, we need to define a core concept right up front.
Let's do it.
The Hive Risk Ladder.
Okay, for anyone new to the framework, break that down. What is the Hive Risk Ladder?
Think of it as a tool that separates noise from actual structural risk. It scores an asset on 5 criteria: liquidity, stability, security, its volatility profile, and its use case clarity.
So it takes the feelings out of it.
Exactly. And here's the most important part. A daily price drop, a drawdown, does not automatically downgrade an asset zone.
That's a huge distinction. Just because the chart's red doesn't mean the asset is suddenly structurally broken.
Right. Volatility is only one of 5 inputs. It's not allowed to overrule the others. If liquidity is deep and the use case is clear, high volatility might lower the score a bit, but it doesn't just crash it into the red Hive zone.
So the question isn't, are we bullish or bearish?
No, that's way too simple. The real question is whether capital is rotating through the Hive ecosystem in a healthy way. We check the blocks. Is seed stable? Is core holding its integrity? Is flow ready for a shock?
And is innovation on a leash?
And is yield being treated as a privilege, not a default? Yes.
So what's the synthesis? What's the uncomfortable conclusion here?
It's that the infrastructure is accelerating while market psychology is, well, it's fragile, and that mix increases the probability of really sharp, non-linear repricings.
The pipes are getting better, but the people watching are nervous.
That's a perfect way to put it.
Let's get into those pipes then. Chapter 1. Stripe. The news is that Stripe is enabling USDC-based machine payments using something called Buy 402 on Base.
This is huge. I mean, it might be the most important piece of news in the whole stack, even if it doesn't scream, buy this now.
And the typical reflex, the Twitter reflex, is to immediately ask,
okay, which token pumps?
Right, do I buy Base meme coins? What's the play?
And that kind of thinking belongs firmly in the red Hive zone. It's narrative hunting, not strategy. If you hear Stripe is building infrastructure and your first thought is to buy a dog coin, you've missed the entire signal.
So what's the Hive Block Strategy view here?
This is a signal for the FLO block.
Okay, and FLOW is usually just our stablecoins, right? Our dry powder. It's supposed to be boring.
It is. But this news changes FLOW from just a defensive parking lot into an active operational layer for the autonomous agent economy.
Let's pause on that. Autonomous agent economy. What does that actually mean?
We're talking about software. Think about AI assistants, bots, software that needs to pay for things like API calls or compute power.
They can't exactly open a bank account.
They can't, but they can hold a wallet. Stripe is building the system for these machines to pay each other instantly with USDC.
So FLOW goes from being a savings account to an engine.
Precisely. And that brings us to the next key term we should probably define, the Hive Flow Route.
Okay, what is a Hive Flow Route?
It's simply the path you decide on beforehand for your capital to take, how you'll rotate profits or manage risk. The key is predetermined, so emotion doesn't make the choice for you.
So what does the Stripe news mean for our routing logic?
It means the hard choice. The right choice is to resist speculating on some random altcoin because of this. This is an infrastructure signal. It validates holding high-quality stablecoin exposure in your FLO block.
So profits from, say, the innovation block should be routed back into Flow.
Yes. The logic is clean. Innovation makes profits. You move those profits to FLOW for safety and now for operations. Then you deploy to core on major corrections. Stripe is telling you the plumbing is getting serious.
It's validating the pipes, not the casino.
Perfectly said. And that by 402 part, it's the HTTP error code for payment required. It's been in the web standards for decades, just waiting.
That's amazing. The code was there waiting for the money to catch up.
And now it has.
Okay, let's move to Chapter 2. This one feels exhausting. Telegram's wallet is listing tokenized equities, things like Tesla, SPY, for 2047 trading.
Stocks without weekends.
It sounds great on the surface, but also maybe a little dangerous. The market closing on Friday is one of the few breaks we get.
It's a classic innovation block signal. And it has a path to maybe being adjacent to core, but only, and this is a big only, if the risk scoring matrix holds up.
So what's the real risk, besides just burnout?
It's psychological. You remove the weekend cooling off period. Volatility becomes contagious. You encourage people to treat stocks like meme tokens checking prices constantly, over trading.
You're bringing crypto-level anxiety to the stock market.
You are, and that ties directly into the Hive Shield protocol. Operational safety isn't just about avoiding hacks. It's about protecting yourself from psychological overexposure.
So if you're trading Tesla at 3 a.m. on a Sunday, you're probably not making good decisions.
You're dopamine looping. And then there's the other question, do you actually own the stock? Is it safe?
That's the zone logic question, isn't it?
It is. If the redemption mechanism is opaque, if you don't know who holds the actual stock, or if a regulator could just shut it down tomorrow, well, then it can't be scored.
And if it can't be scored?
It can't be sized. You can't put real capital there. It stays in the new asset pathway as an experiment until you can verify its structural integrity.
Just because it's easy to buy in a chat app doesn't mean it's safe to own.
Sometimes friction is a feature, not a bug.
Okay, Chapter 3. We're going from the bleeding edge back to the old guard. Danske Bank, a big European bank, is reopening crypto access for clients.
Right, through ETPs for Bitcoin and Ethereum.
And this is a reinforcement signal for the core block.
A very strong one. This is what we call distribution leverage.
What do you mean by that?
Well, think about it. The Telegram thing is a new behavior. This Danske Bank news is about letting big institutional-style capital enter the space without having to change their entire operating system.
So no self-custody, no hardware wallets. They just buy it like a stock.
Exactly. And the reason that matters so much right now, during a dip, is that it acts as a rebalancing force.
How so?
The unstructured investor panics and sells. But the Hive investor sees regime overlap. The price drop hits the volatility profile score on our risk ladder, sure, but it doesn't change Bitcoin's liquidity score or its use case clarity.
So even with this stress, Bitcoin remains a core permitted asset.
Absolutely. Because the fundamentals of access, the distribution, are actually getting better thanks to players like Danske Bank.
That's a good way to frame it. The big money moves slow, and they're building bridges while everyone else is watching the water level.
They turn the spigot on and it stays on.
Chapter 4. FinChain, Avalanche, and something called FUSD, a yield-bearing real-world asset.
Ah, yes, the yield block. This is where we have to be extremely careful.
Why? I mean, the narrative is powerful. Stability plus yield plus an institutional name. It sounds like the perfect product.
And that's the trap. It's a powerful narrative. But we have to apply the risk ladder. Yield always introduces some kind of hidden leverage. The question is, where is it coming from?
Is it safe, short-term government debt? Or is it some complex thing we can't see?
Exactly. So our default stance has to be guilty until proven innocent. If the audits are solid and redemptions are credible, fine, it can earn a better zone. If not, it stays in amber or orange.
And the routing logic, if someone listening wants to try it.
Curiosity has to be routed through FLOW first. You don't take your core savings and dump it in. You harvest profits from other risk, move them to the safety of the liquidity pathway first, and then maybe a very controlled slice goes to the new asset pathway to experiment with something like FUSD.
Treat it like an experiment, not a savings account.
Until it proves otherwise, yes.
Okay, Chapter 5. This one got headlines just for the price tag. Crypto.com's CEO buying AI.com for $70 million.
Pure innovation block. This is what we call narrative gravity.
$70 million? I mean, is that even useful?
Well, a domain purchase is a spotlight. It's not use case clarity. Buying the name doesn't mean you have a product.
Right.
But this is where it gets really interesting if we connect the dots back to what we started with.
Back to Stripe in Chapter 1.
Yes. Think about it. Stripe is building the payment rails for AI agents to transact. And now, Crypto.com is buying the potential identity layer for those agents.
The medium-term narrative is forming right in front of us. Crypto as the settlement layer for the agent economy.
It is. But, and this is the crucial warning, do not front-run the hype. Don't go out and buy a bunch of AI tokens because of this news.
Stick to the blocks.
Stick to the blocks. Core for your long-term holds, FLOW for your operations, and only a small permission sleeve of your innovation block for these kinds of experiments. Don't let the narrative gravity pull your discipline apart.
I like that. Don't let it pull your discipline apart. It's so easy to get swept up.
And it happens all the time.
Okay, before we conclude, let's talk defense. The High Shield Protocol Assessment. What's the posture?
It's heightened operational vigilance.
Why heightened? Any specific threats?
We've had a few things. Bitham had an internal control issue, not even a hack, just an error. We've seen some bridge exploits. It's a reminder that exchange risk isn't always a malicious hacker. Sometimes it's just incompetence.
So what's the rule here?
Crisis preparedness has to come before the crisis. Your documentation has to come before the emotion.
Actionable advice.
Two things. First, make sure your FLW reserves are big enough so you are never a forced seller of your core assets to pay bills. Forced selling is how you lose this game.
And second,
write down your exit triggers now, today. Do not try to improvise your exit strategy when the chart is bright red.
that brings us to the strategic conclusion. The next 24 hours. What's the choice?
The choice is between narrative chasing, buying the AI hype, the tokenized stocks, or structural positioning, which is about protecting your optionality.
And the V2 manual's verdict.
Structural positioning is the only permissible path right now.
Because price is loud.
But the quiet trend, the real trend, is distribution and settlement. Stripe, Danske Bank, those are structural.
So how do we execute?
If the market keeps dipping, you use your Hive Flow Routes for defense. No panic selling. If it rebounds, you take profits according to your pre-written rules. No improvising.
It sounds so simple, but it's the hardest thing to do in the moment.
It is. The market gives you novelty and fear at the same time. Hive discipline is just choosing structure anyway.
Choosing structure anyway. I think that's the perfect place to leave it. Thank you so much for joining this special Hive 5 Dispatch episode, produced by Borghi Consulting and Uncrypto the Crypto.
And remember to treat your portfolios like systems, not like moods.
And, as always, this content is educational only, not financial advice. We'll catch you on the next deep dive.